how do you, each of you play to the effect that we've got, some very different outcomes potential here, with some indicators, forward-looking indicators that are quite negative, despite the fact that the data, as you've pointed out, John, seems pretty reasonable, and everyone is playing into that. But the market is saying 250 basis points of cuts in the US. So how do you cover all bases, I suppose, is the question.
So rate cuts are about the neutral rate rather than a response to an economic condition, right? So that's what the rate cuts are actually about. That's why 250 points. Right? So that's why this other inference. In terms of the US data, obviously with employment data, you get a weekly look at it because you have new claims, existing claims, they come out every Thursday. They're still pretty robust. There's not a lot of change. There was a little bit of noise in the unemployment rate regarding the hurricane the month before last. So I take your point, but the reality is that there are live indicators and they're reasonably robust. The recent reporting season in the US was fine, as was ours. It wasn't great, but it wasn't, and you had the forward indicating comments from companies. As I was talking about some of the retailers, I talked to strong demand, or not strong demand, that's an exaggeration, but reasonable demand. So I think from all those people that sit there and look in, it's not what, one area that I do worry about is much stronger in the US than here, and that's business formation. So business formation in the US is very strong and has been strong since COVID. Whereas business formation here is very weak. And I think that's indicative of confidence. That's kind of that's part of the thinking. But we're aware of the fact that we can be wrong.
How do we cover all bases? For us, we're in a nice position because we're running a much more diversified portfolio. So given that we hold 115 stocks in our portfolio, we can also then hold buckets of what we think of as core value and growth stocks, which then gives us sort of coverage across all potential outcomes. We also kind of take the view that our mission for existing is to help clients stay allocated to a part of the market that is a source of non-redundant alpha over the long term, right? And so we think of that sort of a short-term question about are we entering a recession or is it going to be a soft landing or something else that could be either side of that. But we're looking out over a 5-year period, which is sort of what we think of as mid-cycle, and we're focused on can this company in all sort of market environments continue to grow its earnings, and at what how is the market priced that, and is that reasonable? And we try to stay disciplined and focused on that with that sort of thing in mind, which is that we can cover all bases by being invested in core value and growth stocks across the baskets for us.
Yeah, I think one of the things here is just diversification, Paul. So not having too much of a macro bet in either direction, particularly when it's really uncertain now. It's like, as I said, if the rate cuts are there because they're just normalising policy back to what they think neutral, and we get this soft landing, then there's a bunch of consumer stocks and financials that are going to do okay. So you want to be invested there. But if it's because they're just late and they've already caused a recession and the SARM rule and these other labour market indicators, it softens and then it cracks, right? Because your customers are someone else's, the people you're laying off are someone else's customers, and it snowballs. And that's typically what happens, right? So you then want the quality growth stocks, the defensives, the high moat companies. So I think the key to all of this is when the macro environment's as uncertain as it is today, is not have all your eggs in one basket, have a really well diversified portfolio, whether that's building it bottom up, adding really quality companies that are just going to do well regardless, the Warren Buffett kind of approach, or whether you're not taking too many big macro bets within the portfolio. I think either of those approaches is probably appropriate at the moment.
I met this fellow who's a trader in the United States when I was there, and he pointed out something that really resonated with me, and that's if you take the S&P 500 and look where it's moved from 2022 to today, those capital gains are real and people have banked them, and it's not recorded in savings rates and the like because they tend to go to money market accounts and things like that. You're talking $5 trillion. It's a lot of money, right? And it's in people's accounts. And actually, it's come up in a couple of company meetings we've had where people are financing work through their stock market gains and things like that. So what I'm getting to with that presentation, there's a lot of capital in the world. And so it's already there. There's a lot of capital, and that's helping liquidity. And it may not be in every sector, it may not be in building materials and things like that, they're pretty weak. But it's relatively there. And I think that's one thing that you can see.